All right, so let's just jump right in. We're doing a deep dive today on what's being called the AI bubble leverage risk.
Yeah.
And I think for you listening, the key thing to get is that this isn't about, just inflated stock prices.
No, not at all. It's much deeper.
It's a profound structural shift in global finance, driven by the AI sector's just massive need for capital. We're talking trillions.
Yeah, and what's so fascinating this time is that it's nothing like the dot-com boom. That was all equity, all, promises.
Like software and eyeballs.
Exactly. This is an industrial hardware cycle. We're talking colossal upfront costs, data centers, semiconductors. Yeah. It's pure capex. They hit a wall.
A capex wall. And that's why the money story changed so fast.
It had to. It forced them into debt financing way earlier than anyone expected.
The sources we looked at show AI startups are consuming nearly a quarter of all venture debt dollars now.
That's right, which completely changes the risk profile. It's not about equity volatility, it's structural credit risk.
Okay, so if it's all built on debt, what's securing it? What's the actual collateral here?
Well, that's the trillion-dollar question, isn't it? We're seeing the rise of these neoclouds.
Companies like CoreWeave and Lambda Labs.
The very same.
Yeah.
They're asset-heavy, and they're relying on GPU-backed lending. I mean, CoreWeave secured a $7.5 billion debt facility.
And that's all collateralized by chips.
By their fleet of Nvidia chips.
And this is where the whole structure starts to feel, genuinely fragile.
It is.
Because the killer risk isn't the borrower defaulting on a payment. It's the technology itself.
It's technological obsolescence. It's the collateral, the chips, potentially becoming worthless almost overnight.
So the loan is just unsecured.
Exactly. The functional life of these assets is collapsing because of innovation. Just look at the DeepSeek shock in January of 25.
Oh, right. The startup that proved they could get frontier-level model training for, $6 million?
$6 million, when the industry benchmark was over $100 million.
And that immediately just crushes the residual value of all those GPUs being used as collateral.
It demolishes it. It's technological deflation hitting credit risk head on.
So, of course, the regulated banks got wary.
They stepped back.
Right.
And that created a vacuum that private credit funds just rushed into. Think Blackstone, Blue Owl.
So a huge chunk of this risk is now in the shadow banking system.
Where everything is much more opaque.
So how are these lenders even valuing this stuff if the prices are so volatile?
Well, they often use mark-to-model valuations, not observable market prices. It's easier to mask any deterioration.
Sounds familiar.
It is. And they're layering on complex structures, things like NAV financing and CFOs, which just adds more leverage and risk.
Have we seen any concrete signals that this fragility is, starting to crack?
We have. The collapse of Tricolor Holdings in late 2025 was a big one, a real canary in the mine.
Now, that was subprime auto lending, not AI.
Right, but it exposed the lack of transparency in the non-bank sector.
And the specific risk it exposed was?
The risk of double pledging collateral. Because there's no central registry, a company could pledge the same cluster of H100s to two different lenders. Tricolor showed how dangerous that is.
Okay, so you've got this opaque collateral risk, and at the same time, we're seeing visible stress in the system itself.
Precisely. Just look at the financial plumbing, the repo market. We're seeing serious volatility and spikes in the SOFR rates.
And the Fed's standing repo facility, the SRF, is hitting record highs.
Surpassing $50 billion in a single day, that's a huge signal that internal liquidity is drying up.
So let's tie this all together. What's the final unwinding mechanism? How could this play out?
It's the convergence. The depreciating collateral, the GPUs colliding with widening high-yield spreads. CoreWeave bonds were yielding 9 to 10%.
So if that GPU collateral value drops even further,
it triggers margin calls across these highly leveraged structures, and that shock transmits from the specialized AI sector straight into the core financial system.
So this deep dive really shows the danger isn't just an inflated stock. It's a structural fragility built on risky collateral and opaque finance that, frankly, has echoes of pre-2008.
It certainly does. Which leaves us with a final thought for you to consider. The functional economic life of this AI collateral, the chips, is potentially shorter than the 3 to 5 year loan terms that finance them. So the question is this: will the inevitable rapid technological deflation force a massive credit reckoning before these highly leveraged firms can ever monetize all that debt?